This webinar is a series that is not intended to provide you with opinions that would protect you under Section 37 of the Condominium Act. If you are a director and want to use the protection under Section 37 of the Condominium Act, you would have to get an opinion about your specific fact situation from your professionals. In addition, the information provided in this webinar is current as of today's date, July 15th, 2021. As things change, the information provided today may not be specifically related to your situation. So please refer to your professionals, and also that any references to the Condominium Act or any legislation is reference to Ontario legislation. It's more important than ever that we rely on our professionals during these challenging times. Welcome everyone this afternoon. We'd like to welcome everybody to the July series webinar for projects big and small. This webinar is the second of a two-part series. The webinar series is being offered exclusively to directors in communities that CMG services. I'm Shelley Seavey, your Resource Compliance Manager at CMG, and I'm pleased to be your moderator for this session. This webinar will feature industry experts speaking about specific aspects relating to projects, big and small, and funding as well. Now, I'd like to introduce our two guests that we have this afternoon. We have Lyndsey McNally. Lyndsey is with CWB Financial. Lyndsey McNally has worked with condominium corporations in the Greater Toronto Area since 2002 in a variety of roles, from administration to physical building management. At CWB Maximum Financial, Lyndsey develops and implements customized financial solutions for condominiums across Canada, of course, including in the Ottawa area too. Lyndsey is also on the board of directors for the Canadian Condominium Institute, CCI, and is currently the vice president. She is a member of the discipline committee for the CMRAO and also takes an interest in municipal level activities as well. Lyndsey comes with much experience, and I also am pleased to say that in 2017, she was awarded the Property Manager of the Year Award through the Association of Condominium Managers in Ontario, ACMO. Welcome, Lyndsey.
Thanks so much, Shelley.
And we also have Christy Allen from Davidson Houle Allen. Christy is a partner with Davidson Houle Allen, who provides a full range of litigation and corporation services for condominium directors, managers, owners, and insurers. She also represents co-tenancy associations and gives advice with respect to co-tenancy governing documents. Chrissy works include building deficiency actions, proceedings involving difficult owners and tenants, collections and lien proceedings, including power of sale, as well as matters involving the enforcement of property rights. She also assists clients with their Tarion claims. Chrissy has appeared on behalf of her clients before the Superior Court of Justice, and including small claims, Divisional Court, Ontario Court of Appeals, and various administrative tribunals. Welcome, Christy.
Thanks, Shelley.
And thank you both for joining the discussion today. We're hoping that we'll cut through. There's a lot of information during today's session, and we'll start with project funding. So we have a quick poll that we will launch today to see where everybody is at. So based on your current understanding of funding options, which would best suit the upcoming project of your corporation, if you have a project that's coming up or considering. So if you'd like to, please go right ahead and vote. If you would be looking at a loan only, a loan and a special assessment, or an increase in fees. And if you could just go right ahead and vote, and we'll display those votes in just a couple of seconds. Thank you, everyone. All right, we'll pull down end the poll. And so it looks like the majority are looking at either a special assessment or even a combination of special assessment and loan, or increase in fees. Having a loan only ranks pretty low. So we'll stop sharing the results for now, and we'll proceed. So in this particular situation, let's start with a little bit of a story. So in this particular situation, the board is faced with a dilemma. There's a large window patio door replacement project that they're considering. There's been multiple repairs that are happening, and do we continue down the path of multiple repairs versus planning a replacement project in the schedule ahead? So first thing they do is take a look at the reserve fund study. And it dictates at a certain date that this work is going to be completed. So Christy, can the board look at deviating from what their plan is as far as completing this large patio door window replacement project?
Right. Yeah, so the short answer is yes. As long as the board is taking advice from its consultant, then timing is going to be based on the advice of the consultant. So with respect to reserve fund plans, just to provide a brief comment on that, the timing of the funding, so the contributions year after year are required and mandatory pursuant to the applicable legislation. However, the timing for repairs is an estimate, and if work is required in advance of whatever the estimate is set out in the plan, then that's, again, fine, as long as it's the consultant who's saying, you know, at this point in time, what we're recommending is that this window project go ahead, because otherwise you're going to continue to incur unnecessary maintenance costs going forward. Likewise, sometimes you get to an expenditure in the plan and your consultant looks at it and says, actually, this particular component probably will last another 5 years, so you can push that expense off. So timing in that respect can shift, and it's always going to come down to what your consultant is recommending.
Okay, and it is about timing, really, because if you're looking at some of these major projects that, you know, if you're spending a lot of capital on repairs, nonstop repairs, you have to weigh out whether it's prudent to look at a major replacement rather than continuing with the repairs. So the decision has been made to move ahead. They've decided, okay, we're going to look at that, but perhaps there's not enough funds in the reserve account, the reserve fund, to be able to properly fund this project. So what are their options that they're looking at?
So the options that you've set out here on this slide are really the options that are available to a condominium corporation from a legal perspective. So when you're looking at an expenditure, like the scenario that you're talking about is, it can happen a number of different ways. Either it's an expenditure that comes due sooner than anticipated in the plan, so it's not fully funded. It can sometimes be an expenditure where the timing is in line, but the actual costs are significantly more than what the plan calls for. And it can also just be a completely unexpected expense that could come up. So in any of those scenarios, the corporation is going to have to look at how to deal with that, because the expenditure is basically not in line with whatever your funding plan calls for. So the scenarios that you've set out there are the options that are available to a condominium corporation. A loan, as we're going to be talking about a little bit more today, is available to a corporation if the corporation passes a bylaw, which we'll talk about, I know, in a bit. Especially assessing the owners for the full cost of the project or partial costs of the project, increasing fees just on a going forward basis more generally as an option, and then depleting the reserve fund. So taking what you've got from the reserve fund to spend on this big unexpected repair, whatever the case is, using what you've got to spend on that. And then what has to happen is a new reserve fund plan has to be put together, which will usually involve increased contributions to make up shortfall that the fund now has as a result of taking the money out of the reserve fund. As long as the cost is for major repair and replacement of the common elements and assets of the corporation, you can use whatever's in the reserve fund at whatever point in time you need those funds. But again, it does mean that you've got to get your plan back on track, and that can be achieved by having your reserve fund plan reviewed, and then funding options can be presented by your reserve fund analyst. A combination of one or more of these options or two or more, I should say, of these options is also available to the corporation, and often is necessary depending on the amount of money that you're talking about. I do just want to say, ultimately, the decision as to how to fund, so a condominium corporation has an obligation to maintain and repair the common elements and assets of the corporation. So whether or not you incur expenses is not really the question. If your consultant is saying this needs to be done and it needs to be done within this particular time frame, then the corporation does have an obligation to carry out those repairs that your consultant is saying are required. So the question is more how you're going to fund it. Seeking input. I know a big question that often comes up when we're assisting a condominium corporation facing a large expenses. Well, what kind of approval do we need from the owners? Do we have to go to the owners? From an optics and community perspective, it's always good to bring owners into the conversation. However, the decision is a decision that the board has to make. And the reason for that is because the board has a duty to the corporation to assist the corporation in fulfilling its obligations to the owners to address any issues on the common elements that need to be addressed. So completing repair and maintenance is a duty of the corporation, and the board is charged with the duty of ensuring that the corporation fulfills that object and responsibility. Owners, on the other hand, have the prerogative to make decisions that are entirely within their own best interest. They have no obligation to the corporation. It's the board that has that obligation to the corporation. And that's why the decision as to whether or not to proceed and how to fund the repair item is something that the board has to make a final determination on.
So when you're referring, Christy, to consultant, is this solely the engineer, let's say, that did the reserve fund study?
No. So in terms of making decisions about whether or not, if the corporation is, completing, basically what I'm talking about when I say consultant is going to be an engineer. However, I don't want to mistake the scenario that you and I are talking about, like an unexpected expenditure, with the scenario of just following the reserve fund plan in terms of expenditure. So if the corporation is not obligated necessarily to complete repairs in accordance specifically with the reserve fund plan. So if your reserve fund plan says that windows need to be replaced in 5 years time from now, 5 years or 4 years comes around, and your consultant looks at those windows and says, actually, that repair can be put off. Then indeed that repair can be put off because your engineer is saying it's okay to put that particular expenditure off. So in other words, you're not required, just because your reserve fund plan says the windows need to be done in 5 years. If you receive more specific advice from a consultant saying, actually, you can put that expense off, then you can follow that subsequent advice from your consultant, your engineer. Likewise, if your engineer is telling you, we can't wait, we've got to get this work done now, because otherwise you're just going to have increased leaks and your maintenance costs are going to be excessive, and it's better for the corporation to complete all of the repairs now. That's the advice I'm talking about in terms of following the advice of an engineer. It's important to keep in mind that in terms of planning, the timing that's set out in a reserve fund plan, that's not based on like intrusive or thorough investigations of the component. It's based on a visual review of the common elements and assets of the corporation when a comprehensive reserve fund study is done. So it's only when an engineer does a more thorough review of the item that you can maybe get an updated opinion on timing. And sometimes that means bringing the item forward. Sometimes it means pushing the item off into the future.
Okay, well, so in this situation, the board is going to consider to look at a loan option. Sounds like a scary situation though, because they haven't attained a loan in the past. And so if they are looking at the loan option, let's explore that option a little bit further. So in particular, this particular scenario where there's large project, window, patio door, they've decided to proceed with the project. Lyndsey, can you walk us through where do I start now? We've made the decision. Where do we go from here? What's the right time to reach out to a lender, for instance?
Sure. So, you know, the scenario that you've chosen as an example, a window replacement project, it's a really good one to look at what the normal sequence of events or what an ideal sequence of events would be, because typically a window replacement project, it's not something that sneaks up on you. You know for some time that the windows are reaching the end of their life, and you have a good opportunity to plan. So, you know, when you're looking at a window replacement project or really any major project from a planning perspective, the first sort of piece of advice that I would give is start with an overall review of your reserve fund plan and look at your other upcoming projects. So I think it's a good idea to look at your current year expected expenses in your reserve fund plan, as well as your subsequent year, because you need to get a realistic picture of your overall financial position within this study period. But the other thing that you want to look at is comparing what happened last year to the reserve fund plan, because events that happened in the past can also impact your overall financial position. So big picture, look at everything that you have going on from a major repair perspective at the property and make sure that you're considering all the facts related to those items. So, you know, once you have this information, once you've done this review, you can start working even with untendered estimates, so your reserve fund study estimates, to develop a financial plan. And this point, in my opinion, is the ideal time to reach out to lenders for some advice. So we can help you to understand how this is going to impact your reserve fund study long term. And lenders will not give you any upfront cost or obligation to have a discussion and get some advice about what the options are for you. You know, when working with lenders, it's really important that they help you to understand how the loan will be implemented, because not every solution looks the same, and it's going to have different impacts on your condo fees. So you can use the advice that you get from a lender to make some informed decision about what your next steps are in planning the project. So once you have that advice, the next thing you really want to do is compare your options. So if you're considering a special assessment fee increase, using your own reserve funds, or even a loan, you need to understand the impact of on your condo fees long-term of any of those scenarios. So when you're looking at the fact-specific situation for your condominium corporation, things can change. They're not just related to what's happening in this project. So you need to know how other upcoming projects are going to impact your fund long-term. You need to know where your critical year falls in your reserve fund study. And for anyone that's joining that doesn't know what a critical year is, that's simply the year in your reserve fund study where the balance is going to be at its lowest point in the 30-year study, and also your expected minimum balance, because that provides you some planning contingency, so you know that you're not going to completely deplete or exhaust your reserve funds. So sometimes if you look at the current year in isolation, let's say I have $500,000 in my reserve fund, I need to spend $1 million, so I need $500,000. That may not consider what's going to happen next year. So sometimes corporations just look at the cash outlay that they need and they base their decisions on that. But it's much better to look at the impact of your costs all the way through the life of your study and how it's going to impact your minimum balances in critical years. So really important that you compare the scenarios from that perspective. And then the next step, once you've armed yourself with some preliminary information there, some preliminary forecasts, is communication with your owners. So it's really important through the process, whether you're doing a loan or a special assessment or a hybrid, it's really important that you communicate with your owners early and often. It's a really bad idea to surprise your owners at the end of this process and telling them that the board's done all their due diligence and this is the decision we've made. We think it's the best thing for the community. Owners really like to be a part of the conversation, And if you get feedback early in the process, it helps to make sure that you're choosing an option that's right for the owners in your community. It would be a shame to go down a path to, say, a special assessment, having not consulted your owners, to find that half of your community is not in a position to afford a major special assessment. So get some feedback, make sure they understand the due diligence process that the board is going through, because it's helpful to get buy-in from the owners through the process. It's also good to engage other experts. So your engineer can help you to assist in communication with your owners about the importance of the projects. So one thing that I see a lot in owners meetings when we're talking about loans and major projects, the question always comes up, why can't we just defer the work, right? We can't afford it right now, let's do it in 5 years. And there's some implications in that. There's financial consequences, first of all, in deferring work. But it's just not always possible. And an engineer is in the best position to fully explain the implications to your owners. Once you've had an initial communication with your owners and you know sort of where they're going, this is the point where you can actually go ahead and start having your work tendered in consultation with an engineer or another service provider. So you have a basic plan, you've done some forecasting, you think you know the impact, but you need to have actual pricing so that you can adjust your plan accordingly. You don't want to get all the way to the end and pass a borrowing bylaw only to find out that your estimates were maybe not based 100% in reality, because market conditions are changing really rapidly these days. So you need to adjust in between the initial communication with your owners and when you go back to communicate with them about the final decision. So you have pricing, you can adjust your plan accordingly, and now the board is in a position to formally decide how they want to proceed. And they need to update the owners on that decision as soon as they make it. Again, early and often communication is really important. So you've done that. From there, you can pass the borrowing bylaw if borrowing is what the board has decided to move forward with. One important part of the communication process in passing the bylaw is making sure that the owners understand what the alternatives are and how it's going to impact their condo fees. Owners find it really helpful if you talk in real dollars and how it's going to impact their pocket.
So Lyndsey, I have a question for you then. So, and perhaps either Lyndsey or Christy can answer this one, is in this particular scenario, the window patio door project is being pushed ahead. And let's say that they are entertaining the idea or the option of the funding option of a loan. Do they have to redo the reserve fund study in conjunction with that? Should they be looking at that at the same time? If they're not following it?
Yes, I think they should. I think it's very good practice for a board to consider having their reserve fund study revised whenever they feel like they're going to be substantially deviating from the plan that was laid out by the engineer. If you think that if you thought in your reserve fund study that your windows were going to cost $500,000 and today they cost $1 million, not only does that have an impact on your funding today, but it has an impact on your funding for the long term, because in the future, inflation adjusted, that project is going to be even more expensive as well. So it never hurts to have a financial update of your reserve fund study done. The Condo Act requires that it needs to be done a minimum of every 3 years. But financial updates to the studies, they're reasonably inexpensive. And when you're dealing with major capital projects that can cost in the millions of dollars, it is prudent and practical to proceed with an update of your study. And your lender can help you to navigate the discussion of what that looks like if you're considering including a loan.
And then what about interest rates for loans for condominium corporations? Are they competitive with a personal loan, or how would you say they would compare for a condominium corporation? What are they looking at?
So interest rates for commercial lending to condo corporations are higher than personal financing. Typically, people look at current mortgage rates, especially these days, mortgage rates are at an all-time low. And they say, well, if I can borrow the money personally at 2.5%, why would I pay 5.25 or 5.5 for a commercial loan, which is what our rates are based on today's Government of Canada bond rate? So what you really have to look at is the type of security. So first of all, it's a different type of lending that carries a higher interest rate than residential financing. A residential mortgage is secured against your unit. So if you're the owner today and you sell tomorrow and you've taken out a loan to satisfy a special assessment, you as the owner today must satisfy that debt and pay down the mortgage before you can sell your unit. With a commercial loan to the condominium corporation, there is no security registered on title to the individual condo unit. Instead, we use something called a general security agreement. We're relying on the corporation's cash flow. So there's no immediate cost to the owner. You're not giving up any cash or equity. And the cost of the project can be shared between the current owner and the future owner. So if the owner today sells next year, the loan repayments continue with the condominium corporation. The new owner in this example also gets the benefit of the replaced windows. And windows can last 30 to 40 years. So there's no reason why they can't pay some fair share of the cost. When we analyze the cost of borrowing from a personal mortgage versus a commercial loan to the condominium corporation, oftentimes it's only less expensive to the current owner if they plan to keep the unit for 10 to 20 years at a minimum. If you plan on selling in the next 10 years, the impact on your condo fees is often much less to you as an individual than if you were going to take out the financing yourself at a lower interest rate.
Okay, if the corporation is looking at working with a contractor who will perhaps offer them a loan option as well, so a large window replacement company, is that something that a condominium corporation should entertain, or should they be going to a financial institute to attain a loan?
It's an interesting question. So there's certainly nothing that stops a condominium corporation from entertaining alternate types of financing. They definitely could go with financing through a contractor. You have to be mindful, though, that the contractor will likely have built into their agreement that they can call the loan at any point in time. Even major financial institutions typically have a clause in their agreements that say that you can, like that the financing can be revoked essentially, and there may be a variety of reasons why it might happen. So there's a little bit of risk, I think, in taking out a loan with a window contractor. If you're doing a 10-year loan, for example, will that contractor be in operation for a 10-year period? And I think those risks are really minimized in using a lender, professional lender, or a bank to proceed with the transaction. The other thing too is just because your contractor may be willing to offer financing doesn't mean that the corporation should not proceed with the formal borrowing bylaw. So even if the contractor is giving you payment terms, you're still borrowing the money and you would still need to pass a bylaw. You know, is the contractor in a position to actually help you through that process? And do they understand what it means for a condo?
Lyndsey, that leads us perfectly right into the next slide, which is we're looking at getting a loan. Then it is the corporation must look at a bylaw in order to reach out to their homeowners. And Christy, maybe I could ask you to speak to that. What is the process in getting a bylaw? And if we're looking at a project that is let's say a $500,000 project, do they go to their owners with a $500,000 bylaw, or how does that work?
Yeah, so in terms of the bylaw, but just to put a fine point on it, a bylaw is required before a condominium corporation has the authority to lend money. And generally speaking, a specific bylaw is going to be required for a loan. You can't have, as part of the general powers of a condominium corporation, a power to loan generally. You will have to look at passing a specific bylaw to authorize a particular loan that you're considering. In terms of the amount that the bylaw would specify, so it's through the bylaw that the owners are essentially authorizing the corporation to enter into a loan agreement on their behalf. And so the bylaw is going to set out the parameters of that authority, the extent of that authority. And one of the obvious sort of limits in terms of the authority that you would want to be aware of is the total amount that you are authorizing the corporation to lend on behalf of the corporation, the board on behalf of the corporation. So if you're looking at a $500,000 expenditure, but you haven't obviously yet incurred that expenditure, as we all know, estimates are not perfect. And so in order to, it's always safest to err on the side of caution by providing the corporation with authority to lend an amount that's greater than what the actual estimate is. And the reason for that is you have an estimate for $500,000 and you're authorizing the corporation to lend $500,000 through a bylaw. But if the actual costs come in at $750,000, what has to happen is the corporation has to go back to the owners to get a further bylaw to amend that number, which obviously is impractical, and it would result in additional costs for preparation of the further bylaw, registration of the further bylaw, as well as a cost in terms of the time, because then a new owners meeting has to be called on total of 35 days notice and so on. So it takes time, it costs money. And so it's always better to provide, in my view, a greater authority on behalf of the corporation to loan money. And in the bylaw, it would specify that the money is for the specific work that you're contemplating. So it would indicate that the loan is for the funding of the window project, replacement of windows, whatever the case is. The wording within the bylaw would explain what the loan is for. So you're not authorizing the corporation to lend additional amounts for anything. It's for that specific work. In terms of the process to pass the bylaw, this bylaw, borrowing bylaw, is passed like the vast majority of bylaws within condominium corporations. And that is by calling and holding a meeting of owners at which the bylaw, a vote is taken on the bylaw. And majority of all owners must vote in favor of the bylaw. So basically 51% of all owners must vote in favor of the bylaw in order for the bylaw to pass. I know that more recently, so there's a small handful of procedural type bylaws that can be passed differently. And one of the bylaws that can be passed differently is one that we're all quite familiar with right now, which is a bylaw to permit for electronic voting and meetings. And so if you're familiar with that particular bylaw, maybe that's the most recent bylaw you passed, you would have seen that it passes by a majority vote of owners present at a meeting where quorum is present. In other words, you don't need a 51% of all owners voting in favor of that bylaw, the virtual meetings and voting bylaw. You just need a majority of those who are at your meeting voting in favor of the bylaw. A borrowing bylaw is different. And as I say, it's actually in line with the vast majority of the kinds of bylaws that can be passed by condominium corporations. Because it's more substantive in nature, it requires a higher threshold. So it does require 51% of all of the owners to vote in favor of the bylaw. Once it's passed, it becomes effective when it's registered on title. So it then gets registered and it will show up as a bylaw on title whenever title for a unit is reviewed by whoever, usually a lawyer for a purchaser.
Okay, and so you've gone through the timeline that it takes to pass a bylaw. So the board has looked at getting a loan, drafted the bylaw, presented it to the owners. The owners have voted in favor. It gets registered to title. Now over to you, Lyndsey. We're going to get back in touch with you now. It can both of these. We can't initiate the loan until we get the bylaw, but we've already made contact with you. So can you get the ball rolling on your side? And what does the timeline for that then look like?
So, I would say a typical timeline for a lender to underwrite the credit, go through all the documentation and actually get funding in place for a condominium corporation is about 60 days. And typically what happens is before the bylaw vote, the corporation would engage the lender through a commitment. The commitment typically comes with a nominal cost. I know my firm, if we are unsuccessful in passing the bylaw, which happens very rarely, honestly, the process is not as scary as people think. But if we're not successful in passing the bylaw, then we would refund 50% of that cost. So once you've engaged the lender, only at that point can they begin underwriting the credit. So that's all of the internal work, making sure that we're not going to have any hiccups when funds are needed. So that's ideal. Usually we'll do that behind the scenes so that by the time you pass the bylaw, we're ready to start documenting the loan through the signing of agreements, getting legal opinions, those types of things if they're required. But I would also say if you have an urgent need, you know, you had a surprise in a project and you need funding available ASAP, your lender should be able to support you, provide flexibility in that timeline. And so you would just ask your lender, you know, if you have something that happens and you have a very short time frame, see what can be accommodated, what's reasonable.
So we've gotten the documentation now for the loan. Now back over to you, Christy. It's got to be, there's documents that have to be signed and registered in order to proceed with project payment, release of funds, correct?
So there are, yeah, so typically there's documents that get signed between the corporation and the lending institution. And then those documents are actually not normally registered on title or anything like that. They're just documents that exist between the two parties. Once those are signed, then pursuant to the terms of the particular agreement, funds would be released. Lyndsey probably can comment more directly on sort of what's normal, but I think typically funds are released in order to pay invoices due from to contractors for the work that's being completed. Yeah, I think that's in terms of the documents that are registered on title, it's really the bylaw that gets registered on title. And then that goes out as part of the status certificate package. We also sometimes will include wording within the status certificate to advise owners that there is a loan in place. And you know, it really depends on the particulars of the particulars of the loan and the owner's the obligations of the particular unit owner in relation to that loan will dictate what goes on a particular status certificate. So it's sort of situational as to what goes on, but yeah, sometimes there's wording within the status certificate, and then otherwise the bylaw with respect to the borrowing will be included with the package that goes to the owners.
Okay, and in your opinion then, Lyndsey, whenever you, and you know, to take your loaner hat off to put your lender hat off to put your property manager hat on, in your opinion then, if this is in a status certificate, do you believe that this would be in a deterrent based on just on the fact that there is a loan that the condominium corporation has attained?
So prior to joining CWB, I was almost 20 years as a condo manager, and I did have a number of condominium clients that had to take out loans for a variety of reasons. The disclosure on the status certificate, as Christy mentioned, you know, some corporations may include some wording describing the details of the loan situation. It's actually helpful to minimizing any concerns that potential purchasers may have. So, you know, it's disclosed through the borrowing bylaw. It is disclosed in the audited financial statements. Depending on how you've implemented the loan, it may even be disclosed in your reserve fund study. And so purchasers reading those documents in isolation, they may have a number of questions about what this situation is all about. And so having, you know, carefully worded disclosure within the status certificate itself can help make the situation make a lot of sense. You know, from a lender's perspective, when we are advancing funds to a condominium corporation through a loan, we are taking some credit risk. You know, we would not want to do anything or advance any funds to a condo corporation if we thought for any moment that it would have a negative impact on unit values, right? Because if unit values go down, that increases the risk that the condominium corporation may not be able to satisfy their obligations under the loan. So from both perspectives, I don't see it as harmful. The other thing too you have to consider is, You know, maybe you might have a couple of purchasers that think it's a little scary. Maybe it might have a nominal impact on unit values, if any. But what's the positive impact on unit values of being able to advance the work without a special assessment? Because special assessments are also disclosed in the status certificate. You know, having a loan that's properly planned out and properly disclosed shows a potential buyer that there is a good long-term plan in place, and it gives them visibility in terms of what the long-term impact of condo fees are. If I were buying a unit, I would be more scared of a condo that had a history of special assessments, because you don't really want to be in a situation where you have a condo board that's managing by special assessment on a regular basis, because that could put some personal risk to you as a potential buyer.
Interesting. Well, this almost wraps up our session today. Again, thank you everybody for joining. We have one more poll in closing, which is similar to our opening poll, to ask everybody if you're, after the discussion today regarding your funding options, do you think, would your funding options, your views change in regards to attaining a loan only, loan and special assessment, or increasing fees? So please, if you can go right ahead and vote, and we'll display this vote for very shortly. Again, I'd like to thank Christy and Lyndsey this afternoon for joining us. A lot of good conversation, that's for sure. And we will go ahead and end our poll shortly. So please submit your vote. All right, we'll end our poll and share the results. So now we're looking at the loan option is a little bit further up there. So I think we might have convinced a few other people, that attendees today, that the loan option, it could be a consideration. And Lyndsey, you had mentioned, okay, there we go. That's answered. And thank you very much. And again, thank you very much for joining today, this two-part webinar series on projects. We will be this has been recorded, and it will be posted on our YouTube channel. Stay tuned for our fall series. We will be taking a break in August, but we will be returning in the fall, and we'll have more interesting topics and industry experts that will be presenting as well. And again, thank you very much to our presenters today. The CMG team is proud and honored to serve our board of directors and owners of our communities, and we thank you for joining. Have a great day, everyone.